Can we set you? Yes.
Are we recording?
Good afternoon, everyone. Good afternoon. Bon appetit. Very good meal. Welcome to everyone. Thanks for being here. This is so far the most best attended of these IU lunch talks. Is that 14? I don't know, because of topic or the person, or maybe just the time of the year. Or maybe the topic. I will tell you something about that in a minute. This is the 14th of the IU talks, Independent Evaluation Unit, monthly talks. So welcome on behalf of the unit, as well as of Joe Puri, who is the director. We had about 60 people registering for this seminar, for this talk, and we have about 40 people here already, so it's good to start really on time. We don't wait this time. I will give some introduction about Sergio. He's the head of the private equity fund at the GCF, a long experience in private equity, clean energy, energy efficiency. Latin America, of course. I understand he's Colombian. And he's been working on for a long time with the International Finance Corporation, with the EBRD, the European Bank for Reconstruction and Development. And he is a GSC from the Pontifical Javierna University in, I guess, in Bogota. I think that's search interest before this. And he has also MBA from American University of Washington, and the private equity and venture capital certificate from Harvard Business School. He is also on the board, of course, of global private equity funds, as well as museums in the Washington, D.C., Baltimore area. So that shows talks for his interest. Now, the topic. I've been looking at his presentation. They've got some keywords there. Looking at the presentation shows that he's going to talk about marriage, one of the most complex topics of this world. He's going to talk about dating, speed dating, and of course, linked to it, casting the spell, which always happens with marriages. Well, but more specifically, I'm going to talk about another topic, which is very relevant to the GCF, but also to the IU and evaluation for the future, is the marriage of private funds and institutional investors for impactful climate investment. We are going to run this talk as we normally do. Sergio is going to present for about 20-25 minutes, and then we'll have quite a large session of Q&A. So it's very good, and thanks to you all for coming here on time. We do need the time after his talk for giving the floor to your questions as well. So without any further ado, I give the floor to Sergio for his presentation. Thank you very much.
Thank you very much, Roberto, and thank you. It's very humbling to see all my colleagues and senior colleagues actually here. I don't know if this is working well. It is. Yeah. So talking a little bit about marriage, I just showed the brochure of the independent evaluation, and it talks about trust and about information and about high impact. So all of those are actually in line with the marriage topic that we are going to talk today. So a little bit about what is the statement of fact. We all know different, by the way, there are more sittings here for all you guys, if you want to come on here. It's been assessed and ascertained that about $7 trillion are needed to be invested annually for the next 12 years in order for us to meet the 2 Celsius goal in Paris. As a matter of fact, only 6% of that is being globally invested. It's about 400 billion. So why aren't private equity, public sector investing more? Am I doing this well or what? And do we care actually to cover this gap? And who can invest and fill the gap? This is an analysis that CPI produces every year. It tells what are the sources of and who is investing in climate change. Well, approximately 50% of the 400 billion, the 6% that we were talking, is actually invested by commercial financial intermediaries, by corporate actors like Enel, and by banks. About 10% are invested from retail. Those are households, basically savings and retail. And the blue part is actually invested by either governments or by DFIs. So about 60% of all the monies that are invested in the world in climate change are actually invested by private investors, and 40% are invested by public sector. But there is 1, 2, or 3% that are invested by two actors called the institutional investors and private equity funds. And they are developing fast, and they manage a lot of monies. And this is the point of this presentation. How can we make the two of them work together and actually invest more in climate change? A little bit about what are private equity funds. If you don't know, it's called private equity funds because they invest not in public equities, which are sold in the stock market, but they are invested in companies, family-owned companies, small companies that haven't yet reached the capital market. They are pool of investment vehicles, only qualified investors. So for you guys that have more than $2 million in your checking accounts, you can become a qualified investor in a private equity fund. Usually they have two parties. There is a fund manager, there are investors, and typically institutional high net worth individual and sovereign wealth funds invest in this, high risk profile investment. You can invest in debt, equity, and mezzanine. But one element that is very important about these structures is they mobilize a lot of money. So an anchor investor like GCF can come in and invest 10%, give a lot of support to the fund manager, and that fund manager goes around the world and raises capital. So that mobilization, Douglas, there is still seats here. So that mobilization is extremely important to the marriage we're talking about. And who are the institutional investors? Well, these folks are people like pension funds, family offices, high net worth individuals, sovereign wealth funds, university endowment, insurance and reinsurance, and they happen together to manage about $72 trillion in the world. Actually, between the institutional investors and the high net worth individuals, they shouldn't be here. They manage twice as much. They manage about 140 trillion in the world. They require a lot of transparency, clear governance, long-term investments. They need high diversification. They need investments that generate dividends and some income. They need a strong governance, and that includes, environmental, social governance, gender, legal structure. So the question here is, together they are managing 140 trillion. Can they together actually invest in climate change and help cover part of the gap that we are talking about? How can private equity funds and institutional investors work together and be more impactful in climate change? We can invest in different ways. For instance, we are already investing through GCF in funds of funds. You will remember a project called GRIF. That's what GRIF is doing. We invested 20% in GRIF. They are investing in different funds. These funds are mobilizing more capital in their countries, in their regions, and they will invest, along with other investors, in projects which, by the way, they are also mobilizing additional capital. When we take into account the 20% that GCF, may or may not invest in these funds, with the ultimate mobilization of capital at the project level, sometimes the expected mobilization can be $1 of GCF for $30 that are mobilized in the capital markets with these investors. This is important, this high mobilization, at the time that we realize that our capital in GCF is limited. So we need, this is the case for high mobilization. We can also invest in a fund, being an anchor investor, where we basically go invest about 20% of the fund. And in this case, the mobilization will be, a modest mobilization of $1 that GCF invests for $5 that we can mobilize in the market. Or we can also invest in mobilized funds. These are just some examples to tell you that if the institutional investors start investing in all these projects, in all these funds, we can achieve a high mobilization of capital. The second one, private equity funds are also investing in and supporting technology. Technology is important in climate change. Technology usually is originated in developed markets, yet we are working in developing markets. So we are investing, for instance, in a private equity fund called Princeville. And Princeville is raising $250 million. Probably the GCF will be an anchor investor, which means that we move quickly, we support them in front of the world, the capital markets, and that seal of stamp is important for the fund manager. Another way that private equity funds and institutional investors together can really cooperate and create positive synergies in climate change is investing in early stage climate-related innovation. This is the case of the Teslas, the case of other investors in the new products in the market, where somebody comes with an idea, there are some angel investors, you create a widget, a service, then you mobilize venture capital and private equity to create the company. Later on, there is more private equity company funds, rounds, technological investors, market, commercial banks. Finally, you create, a public company that can have access to the market. Basically, private equity supports business from ideas to mature companies. Other private equity benefits, private equity funds benefits, it is important that GCF is an anchor investor. And an anchor investor, not many banks, investors want to be an anchor investor. That is more reputational risk, means that we have to really know the fund manager we are supporting, because we are telling the world we are supporting this private equity fund manager. But there is a value on that. Also, we are telling through our due diligence to implement best standards, and that is strong environmental, social governance, clear legal structure, and climate narrative. GCF also supports local private equity fund managers, and this is an important support, because when they go to their NDAs, basically they need to demonstrate why should the NDA basically issue an NOL, why should they invest in their countries. We also are making sure that whatever investment strategy they are using is actually in line with the NDCs. I don't know what happened here, but yeah. So you can ask, why hasn't this happened? Why are they still investing only 2 to 3% in climate change? So all the problems, of course, have an economic reasoning. Developed countries' public stock, especially in the United States, are totally overvalued, and so people are, investing in companies that are already public companies, and they are making a return of about 16%. If you invested in the United States in stock market last year, in 1 year you could have made 16%. Well, what happens is
if you invest in a renewable company, in a renewable project in a developing country, you're expected to only get 9% return. So obviously, there is a disadvantage there. So we need to be very frank. Also, if you invest in the stock market in any developed country, you have some liquidity. At any point in time, you can go, you can sell your shares, you get your money. That doesn't happen investing in a private equity fund in the developing country. That is low or modest liquidity. So there is a role of PSF to play here. For instance, we can help with our concessionality to actually transfer it to the sponsors, to the investors, for them to really start investing more, equalize this, economic distortion then of the market. There is also a misperception of project risk. Of course, that if you invest in the developing countries, your risk is going to be higher. That's not the case all the time. From time to time, it is. How can we change this distortion? How can we make sure that private equity and institutional investors can actually work together more from the point of view of GCF? We need to start being extremely selective in terms of private equity deal flow in GCF. We should be supporting projects that have basically a very strong climate narrative and that are also, produce a positive IRR. Build a strong reputation for being the best climate investor in the world. And we have the talent. The talent is here. We need, only then we can attract institutional investors to co-invest with us. Every project that meet our standards, let's invite these institutional investors to come and co-invest with us. And this is the way that we can become impactful in climate investment and change this paradigm. So how do we set up the marriage from now on? There is this process of casting the spell. We already casted the spell. We went to the world last August and we told the world, if you have a very cool project that is mobilizing or has the potential to mobilize capital from investors, private investors, please pitch in to us. We received about 350 concept notes for a total request from GCF of $18 billion. Out of those, 36 concept notes are private equity funds. They are requesting from GCF $2.8 billion. They are mobilizing additional $7 billion. So the mobilization there is actually quite high, $3 to $4 for every dollar that GCF may invest. How can we start speed dating? How can we make this more of a process that is ongoing? We are establishing the first GCF private investment for climate conference. Is going to be held here in June, next October 10th, 11th. We are inviting institutional investors to get to know us, for us to speed date with them, to tell them what is it that we have in terms of pipeline, in terms of talents, what can we do for them, and at the same time for them to get to know us. A little bit about the conference. The conference is supposed to be the start of a marketplace. It is the first marketplace for private investment in the world, and certainly the first one in Asia. We are inviting more than 600 guests, about 80 panelists from more than 100 countries. Institutional investors, including high net worth individuals, globally manage more than 140 trillion, yet they invest only 2 or 3% in climate. We want to change that. We all need to change that. As a takeaway, we are lucky to be at the GCF. Even despite recent news, GCF is becoming. This is Clinton's old word. That becoming means We are not yet mature. We are an infant that is, slowly maturing and becoming a reputable institution. We have what it takes, which is we have some capital, and we have the talent, and that is all of us. We need to be selective and impactful in the way that we select our projects. And I think that the Private Investment for Climate Conference is actually a very positive event for all of us. Thank you very much. And if I, can answer any questions, I'll be delighted to answer.
So thanks a lot for Sergio for this very interesting educational presentation. Also for me, many of these terms are unknown. So I guess we are going to the first part of this Q&A session as really questions. If you have anything unclear about the terminology being used, what all these things mean, it's a good chance to ask it also because we have time, so it has been very good to be on time, so we have more than half an hour for questions and further comments. Just a small reflection about this. You just mentioned, last thing you mentioned that on these fields, the GCF is compared to an infant, perhaps. Just over the last couple of weeks, I was in a mission with other colleagues for an evaluation first in Senegal and in Kenya, in which I met several people who came forward and saying that they were going to come to this conference in October. So that's going to be an important event for GCF, and it's an innovative part of GCF also, it's private sector. And at least I got a couple of questions about how is GCF doing, of course. Of course, people follow the news and so on, and in general, my answer was that GCF is not an infant yet, is not adult yet, but it's kind of teenager or young teenager. But from what Sergio's been saying, then he's been comparing it to an infant in this term. So maybe we can also elaborate a bit on why some people may define a teenager, not yet an adult, and in some other terms, an infant. But having said this, I think we go straight to the, I would say, clarificatory questions to anything that Sergio can help us to understand more on this aspect. There are several people, and there is no more chairs, unfortunately. There is only one over there at the end of the stage, and we can start. So the first one, let's take a few questions first. Let's start, if possible, with clarifications or need for further explanation about what it means by these terms. So can you raise the hands again? One, and then two, and others? Other clarifications? Third one. So most people have it clear. Okay. All right. So let's start with the first one, please. Your name also and your question.
Thank you very much, Sergio, for the presentation. I'm Prabhaksh Patel. I work with Steve. Sergio, I had a question for you on one of the slides. I don't know if you go back to it. There was a slide that was referencing return.
Yeah.
And there was something a little bit, I think it's turned off. I'll just try and speak about it. So it was referencing the returns, that one right there. And there's something a little bit counterintuitive from what I remember in my finance days, my MBA days, which is this expected returns or are these actual returns? Because risk return has a strong correlation, and the more risk you take, the higher expected return. What you're showing here is that developing markets actually have lower returns than developed markets, whereas the risk is typically higher in developing markets. So can you talk about whether this is actually expected or actual, and if it is expected, why is it that you've got it the other way around? Because that certainly does not follow typical finance principles.
Second one. Your name first.
Thank you. This is Shamir from the IRM.
Your name first. Maybe just stand up and come closer to us.
I think I have a very loud voice. I'm Shamir from the IRM. I'm just curious about your reference to the $7 trillion that you put in the beginning of your slide. Is it purely infrastructure investment, or it's climate finance or green finance, whatever way you define it? Thank you.
Somebody else on this side also?
You also raised your hand.
I did.
Did you regret it?
That's a clarification question, just but the
going back to the returns again, you mentioned about you could expect higher returns in developed markets right now over the last few years. But in the last several months, there's been a lot more volatility in those markets. Do you foresee that as having an effect on more capital flowing into some of the climate finance, or does that volatility transfer over to that as well?
Can you take this question first, please?
So this is basically an oversimplification of what's happening. But you know what happened, you know the story. In 2007 or 8, there was a meltdown around the world in the financial markets. Ever since most countries that had the possibility of doing injected capital and liquidity to the markets. Certainly that was the case in the United States, where the Federal Reserve has put so much money into the market, and it's cheap money. As you said, right now, after 7 or 8 years, you know, the economic policies are changing and they are reversing, and they are creating turbulence in the market. Everyone is like, where is my cheap money? Okay, mortgages in the United States are coming up, in interest rate, and so are interest rates. What you are seeing here is this is totally inflated. You put money in the stock market last year, you could have made in 1 year 16%. That is totally irrational. It's something that is totally unsustainable. What's happening is, the Fed is correcting now. It's taking money out of the market to stabilize, the craziness of the market, if you will. I would say that this year you will see that this 16% is not longer 16%. It will be probably single digit. So there is no logic about this. It's totally inflated. It's companies that are growing, that are borrowing monies, cheap monies, and equity prices that are being, fictitiously inflated. But what I can tell you, the truth is this. The economic truth is you can go to any country in the world and you can do and invest in any renewable project, and they will be giving you probably anywhere from 9% to 12%. This is solid. This is on the basis of economic, solid grounds. What's going to happen is what the gentleman said before. What's your name? Tim. It is absolutely true. What I do expect is as the developed markets and central banks start tightening, their policies, their money circulating, what you're going to see is that all these returns are probably going to start balancing differently. And probably this will be, the same rate, but these rates are going to come down to probably, 5, 6, 7% as they should be. So it will be a lot more logical from the point of view of risk and return. But, right now, that's what we have. There is a lot of volatility in the market. There is a lot of volatility in the FX because all the countries are trying to defend their treasuries, their bonds, and their investments. But this is going to correct itself because it is totally unsustainable. There was a question and I forgot.
7 trillion.
Oh, the 7 trillion. The 7 trillion is a little bit more complex. The 7 trillion is based on infrastructure investment. It doesn't take into account, I suppose, Bloomberg New Energy Finance probably increases that 7 billion by probably 2 or 3 trillion that needs to be invested in energy only. But the 7% is the 7 trillion is calculated by New Climate Economy (NCE) and by OECD. So I'm not pretending that that's the amount that really is going to get us to the under the 2 Celsius. But it's the best that Sandra Freitas and myself and Simon have been able to agree after fighting over this for probably a month. So it's something that I wouldn't quote, but I think is up there. It's a lot of money. We're only investing 6% of that 7 trillion. That's the truth. Any other?
Okay, can we go for unless there is follow-up on these questions, we go for a second round. Do you prefer getting questions together or one by one? Whatever counts. Okay, who are the next ones on the list? So 1, 2, 3. Let's go 3 by 3 times. 3 questions every time. Okay. So the first one.
Demetrio from the manager of.
It works actually.
Yeah, whatever. Can you hear me? You can use that one.
Actually, it does work.
Doesn't work.
Yeah.
It's my magic touch. Make it working even better. But it's fine. I'm Demetrio. I'm the manager of the simplified approval process. No, thanks, Sergio, and thanks to you and all your team for the amazing work you're doing also for the conference. It's going to be a milestone for this organization. My question might be a little bit basic, but it's really what GCF, what PSF would say to a private equity fund, to a net high-worth investor, if they tell you something that in Wall Street is a motto, time is money. How long it takes to you to provide us this money? Well, you bring it to us, we bring it to the S&T, they like it, they might not like it, the type maybe like it not, maybe the board will decide on that if they discuss the project 2 years. Now, I think this might be a serious issue for most of very serious private equity funds that have a serious project. Time for syndication it's money for them. It's even more important than risk-adjusted return. And what is the communication that PSF give out if this type of question are asked?
There was. Hello? Yes. Yes, was you.
Oh.
You also regret it?
Well, I was going to ask to say that, you're aiming to bring basically institutional investors to play into the climate space. I just wondered what the comparison is like. What does it look like for institutional investors already working or coming from developing countries versus those in the developed? How big are the capital amounts that we're looking at? And to say GCF is doing something specific to address this particular tool, so maybe there may be differences between those operating in developed and those in developing countries. Let's say, how much effort are we applying and through what means to get capital from both sectors?
Okay. That's a very good question also. There was a third one over there. Yes, please.
Okay, thank you. Oleana from DCP. First of all, thank you very much. It's been really interesting. And you obviously have given a lot of thoughts into it. So I'd like to echo Dimitri's question and bring you on more of a general ground. In your view, what would be the main barriers that need to be addressed by us, but also maybe by our potential partners? What is it that stands in the way for us to work with the private equity funds?
That very interesting questions. Some of them, I don't know if I can have an answer. But Oleana and Dimitris, you sort of touched upon something that is extremely important. How fast we can react from the point of view of the institution. How fast can we deliver? That is a challenge that we are looking at right now when a private equity fund comes. And, large private equity funds, those that are already managing 500 million, 1 billion, 2 billion, 3 billion, 20 billion, the KKRs, the Carlyles, they can come and wait 2 years to be accredited at the GCF. They have the power, they have the money, they have the lawyers. But the most important players, remember, climate change as a business segment is fairly new. So you are not going to get too many private equity funds or institutional investors, for that matter, that are investing for 10 years in climate change. It's not going to happen. All of us are learning about this. But local private equity, what we call first-time private equity funds, who are, by the way,
very smart professionals who are from Africa, from Latin America, from Southeast Asia. They went to school to Europe, they went to school to America, and they go back to their countries and they are raising their first time private equity fund. They are the ones that come to us, to GCF. They don't have the money, the wherewithal, and the patience to really wait for us for 2 or 3 years. So they are the ones getting disappointed, really. So what are we doing with our colleagues of the accreditation department, with URBASH? We are raising this big problem to management and to our board. We are writing a letter to SMT telling them, guys, we went to the world. We brought 350 concept notes. Of those, there are 36 concept notes of very good local first-time private equity funds that would like to raise capital. We can be anchor investors for them, yet we still don't have a modality in GCF to really go and support them. So this is part of my takeaway. We are not yet a mature institution. We are not yet driving, we don't have the modalities internally to operationally move fast. We have the talent, we have the intention, the will, and we have some money. Yet we cannot act because we don't have the modality. There is no way that the accreditation panel yet can have, a script for them to analyze what should they be looking into a local private, fund, a first-time private equity fund. So it is a challenge. We are trying to do something about it. I hope that next year, if I get invited, to deliver another analysis, we can tell you that we have done something about it. But it's a big problem. I'm not, saying that it's not a problem. Regarding the institutional investors, talent and money is globalized. These institutional investors are friends of yours and mine. They went to school. They are extremely well educated. They know the script about climate change. They know they have to invest more in climate change. Whether they are locally or they are regional or they are universal is a matter of size and investments, but they already know what to do. Now, most of them, when you tell them, why have not you invested in climate change, and what can GCF do in order to expedite, in order to spur that investment in climate change, they will all tell you, we need, number one, a conduit that is, cheap to do it. We need the private equity funds. We need an investment. We need the GCF to come to us and tell us, hey, invest in this fund in Southeast Asia, in Latin America. They don't have that. Secondly, they don't want to be embarrassed. Remember, they are managing monies that are serious monies. They are my retirement. They are your retirement. They don't want to be on the first page of a newspaper. So they need to invest with somebody serious. But they know the script. Every time that we invited, and we are inviting many of them to come to the conference, they know and they are happy to come here and to tell us what is not working and what is GCF need to add for them to invest more in climate change.
Thanks again. So very good questions. But perhaps still too easy because you managed to answer all of them. So I don't know if you can think about those bigger picture questions or those basic questions that really put the speakers under a strong test.
Yeah, just one more.
So just prepare your questions before.
Yeah, one more comment. The conference is not PSF conference. The conference is the Green Climate Change Conference. We have a team of about 15, 20 people, a committee, Simon, Sandra, many of you, Inchan, Theo, many of you are part of this committee. This shouldn't be seen as it is PSF because it is not. It happens to be a conference that is being branded to invite, to lure, to date institutional investors. And as such, the first pitch was,
okay, let's give it to the private equity fund guys because they have some links with institutional investors, and we do. But, it's not it's our conference, it's GCF. And it's important that you are all helping us, supporting us, and we are going to go to you more and more these days, to ask you, please help us volunteer to the conference, because the conference is a big effort. There will be 600, maybe 700 people. Seems like the Korean government may help us to go to 700 now. And it is an important effort for GCF, not for PSF alone.
That's actually going to be first green climate change.
It's called
Green
private investment.
Green climate fund, not the climate change.
Sorry, green. Yeah,
Okay.
GCF.
And that's going to be here or in
It's going to be here in Incheon at the Grand Hyatt.
Shanghai, not here in
October
GCF.
2011.
Not here
It's
in
not.
GCF. Okay. All right. So other questions, especially if we can start moving this discussion to a bigger picture and maybe on the evaluation side. So how can we plug that in? So, Sadie, and then yes, and then the third one again.
Hi.
Third one at the stage. Yes. Okay, Sadie, please.
My name is Sadie, and I'm from the IEU. I'm just wondering, so if we're obviously only part of the picture of climate finance, and so I'm just wondering who are the other biggest players in terms of proportion of climate finance, and on that, like how are we working with them to ensure that investments are synchronized or something?
The answer to that is, the biggest players at this point, just because of the need, are basically the technology providers. Companies like Enel. I don't know if you know, Enel is an Italian company that landed in Latin America, and they really changed the face of renewables in Latin America. This is the first time where Latin America was paying, I think 10 years ago, $700 for the megawatt. Now Latin America is paying $40 for the megawatt hour. This is incredible. This is paradigm shifting. But it happens that Enel is not a bank. So, and they didn't get any financing from anyone. Probably, the European Union gave them some money here and there. So they started putting assets and borrowing money against their balance sheet. But that's not their business. So at this point, if you see, they have about 20 or 30% of the total segment of who is investing. But they have to start deleveraging that, because that's not what they are. They are not a bank. They are an institution with folks that are trying to disrupt markets and bring technologies that are cheaper, that are more affordable. So what you are going to see is the source of investments are now changing. They are about, on average, 400, but they need to change. Why? Because Enel cannot longer put more assets and more financing on their balance sheets, as profitable as that is. So that has to start changing. Who is going to be the next one taking from Enel this? I don't know. Probably Enel is going to securitize, produce papers, and they will sell it to people like you and I. And suddenly, households like you and I are the owners, and we will be the providers, as it should be probably, of, financing for climate change in the world. But at this point, it's banks and technology providers. Hopefully, in the future, we can tell you that it's going to be institutional investors and private equity funds, the ones that are actually, undertaking more and probably scaling up the investment. Is it coordinated? No. It has been a function of how, this market has developed, which is not in an organized manner, and competing with economic forces that are volatile. But it's changing. That I can tell you.
Then let's follow the other questions. There was here, and then there, and then one more. Yes. So let's take three at the same time now. Again, me. Yes.
Hey, I'm John, working at OED. I want to go back to the symbol of marriage because I love marriage. I love my wife.
It's on record now, right?
I listen. Actually, I think the marriage between GCF and the private equity has got some fundamental challenge because private equities pursue capitalistic interest while we are pursuing human challenge interest. So to get married, I think we have to make us look sexy, very attractive. So how do you think that we can be more attractive and sexy? That's the first question. And second one is, this is a kind of challenge question. Can we use them as our replenishment source?
Okay, thanks very much for moving to the really challenging questions. And second one, we give you time to think about it. Yes? Oh, no, sorry. It was you first.
Yeah, my name is Hayan and I'm working for the city. My question is, could you give us a little bit more concrete picture about the conference or what is cooking right now behind the scenes? Because I think all of us in this room are really fully understand the meaning of the conference. It would be the first in the world to collect all of the private funds for climate investment, and I think it would be very good to what would be the kind of a focus to get out of all of the obstacles like that. But I think in terms of actions, what do you have in mind? For example, a few years ago at the high-level conference of this fund, there was that time it was about governments. So many governments made their contributions to the fund. They made announcements, kind of that. So what do you have in mind about the actions of the conference?
Very good. Okay, and the third question.
Hi, Sergio. This is Linus from OPM. Thanks for the great presentation. I have a quick question on the, so I'm interested in the 2 to 3% who are investing in climate change, institutional investors and private equity. So my question is, what are the GPs and their portfolio companies doing to actually measure the exposure to climate change? And what would they mean to the long-term profitability? It's more of a general question, but if you could give us a thought on that. Thank you.
Very good. If you were to, Linus, let me take that question on. If you were to see a matrix of all, the possibilities that you can invest in climate change, the space of climate change, including what the GCF does, and we don't have that here, right? You will see it's incredible. Money have been flowing to most large utility-size projects. Those projects that are 10 megawatts photovoltaic or more, wind, some fossils, replacement technology and all that. Where the money has not gone is to, number one, all projects that are 1 megawatt or less. And those are, retail, small projects, communities, household, rooftop. The money has not gone there. And it has not gone there, I assume, because it is easier to invest, $50 million rather than investing probably $2 million in a 1 megawatt solution. So the money has not gone there. The 2 or 3% has gone to the large projects. There was a big project in Morocco, photovoltaic. I think it was how much? 100, 200, 300 mega, I forgot. That's where the money is going.
That's where IFC and all these, big DFIs are going. That's where the car labs go. It hasn't gone to adaptation. It has not gone to small projects and private equity and institutional investors. Remember, institutional investors, although they are managing 140 trillion, when you go to visit them, they are in one floor of a building like this. They don't have more than probably 150 people working for them, because that is a business of investing a lot of money with low cost. So they would like to invest in climate change, but they don't have the expertise, and they will not hire any of us, because the more they spend on their human talent means that, they will be less competitive than the other institutional investor, where the clients can go because they are cheaper in terms of what they do. So institutional investors are basically relying on institutions like us that have the deal flow, the concept notes, that have the ability to show them where are the projects that they can invest, and yes, where are the projects where they can make an IRR. That's where the monies are going. Still, 90% of the market is out there, and the 90% of the markets are very small solutions for households, for smaller companies, medium enterprise, for farms in Africa. There, the money hasn't gone yet. Not because the projects are not lucrative. Those projects sometimes can be incredibly lucrative, but it's just because people invest in what is easy and the low-hanging fruits. So the 2 or 3% has gone there, but we hope that more money will follow. There was another question about the conference. I'm sorry?
And also another question.
Oh, about the marriage. That's a more deep question. I suppose, John, that you are right. We need to start looking a lot more spiffy for the institutional investors to start looking at us and respecting us. Now, let me tell you this. I remember, and some of my colleagues here last year, to visit KIZ, the Korean KIC?
Yes.
KIC, the Korean Investment Authority. And they were telling us, look, we are investing in Asia. We are not investing in the developing world yet, but we would like to. If you can show us that we can make, a return that is concomitant with the risk that we are taking, we are delighted to at least listen to you. And let me tell you, Koreans are not famous for going around the world and investing, but these guys, as parochial as they are willing to listen to us. Okay? And yes, there has to be a return, because that's what, they are there for. They are there to basically earn a return, transfer it to their clients, and we need to do that. There are areas that are more difficult, and I don't have the answer. How do you make adaptation much more interesting and palatable for private sector? I don't know, but when the private sector gets in trouble, when the Coca-Colas, the Pepsi-Colas, or all these companies that need water get in trouble, they immediately start investing in adaptation. So I don't know, maybe that's a way that we should start approaching adaptation in private sector, identifying where are the sectors that are critical for the private sector. And there are many important sectors. Agri is important for private sector. Land use is important. Probably, smart buildings. All of these are important for private sector. So I don't know. I'm just putting some thoughts out there. The lady asked me about the conference. So since we met your constituents about 7 months ago, we have done a lot of work in the conference. At the beginning of the conference, a conference of this type, this is going to be an important international conference. Countries will die to have this conference be replicated. I told you this 7 months ago, you probably didn't believe me. But since then, we have secured 600 people, 80 speakers. We are still trying to rebalance, the gender equation to have much more female professionals coming here. Is extremely expensive. A conference like this in Washington costs $1.5 million. Here we have done it with little monies from here and there. And that's why it was so important, and it is so important that the city of Incheon and the city of Songdo support us in this, because the quality of this conference has to be better than anyone, because not many people can take a plane for 16 hours to come from the US here for this conference. So we need to treat them well, have very good content, have very good hotels, have very good ways of supporting, their invitation here. Since then, we have also heard very slowly from the country of Japan that they may be interested in supporting in the future this conference. And I don't know, there will be a decision made whether this should be a traveling conference or whether we should have it here in Incheon. But we are still looking forward to hearing from your constituency. We have financed this with bits and pieces from different departments. We still would like to increase the attendance from 600 to 700, and there are still other expenses that we need to cover. So I shall be delighted to maybe talk to your bosses and actually show them what we have done in the past 6 months, and they still have the opportunity to make this, maybe a Korean-based conference. This year, GCF was very willing and very generous to give us some monies. In actuality, probably next year, the GCF may not have the possibility, so we will have to charge. And that's okay for this conference, but it takes 1, 2, or 3 years until the conference is established before we can start charging the people and transfer the cost. So we are still looking for a country, a city to support us and be our partner in this conference.
Thank you very much. I think it's a good note to end this meeting. So it's basically the next step. So it's following, and this meeting has been very instructive for everyone. And the presence in this meeting has been exceptional, and that speaks to the interest of the topic, relevance of the topic for GCF, but also of the quality of the speaker and the competence. You don't want to hear about that? No problem. But that's the reality. And normally, my colleagues told me that when we send these invitations, normally we see the reaction, how people react, and we divide it by half, and we say that's how many people will show up. And that's the number of people the number of sandwiches we normally provide for them. So probably something went wrong this time, or went too well, because out of the 58 people who accepted, 65 came here today for this meeting. So that was really, really good. And with that, I would really like to thank you for your participation. It's been very interesting. And let's have a round of applause.